Our next lecture is on transacting insurance. The insurer, being that party who is unfamiliar with the risk being presented, needs information about the risk. This information, known as material information, is gathered at proposal stage. It is through this information that the insurer decides whether to accept the risk or not. The usual method of obtaining material information is the proposal form, which eventually forms the basis of the contract. On a proposal form, material facts are sought by means of specific questions. The proposal form is a declaration form, since the insured will sign that the facts being disclosed are those that are true and correct to the best knowledge and belief at the time of proposal. The proposal form is a convenient and cost-effective way of obtaining material information. There are general questions asked on all proposal forms. However, there are then specific questions which are specific to the type of class of insurance being considered. This slide displays some general questions. This slide gives examples of specific questions related to the type of class being considered. A declaration is an undertaking that what the proposer said is true and correct at the time of proposal. Such a declaration will be the basis of the contract. There are other information sources, like, for example, when an insurer carries out a survey, or when supplementary questions are asked, or when questions come through an intermediary by means of a slip, for example. Sometimes the underwriter arranges a face-to-face meeting to obtain information by means of an interview, or this could also be in the form of postal or electronic correspondence. A survey is carried out when the risk is either too complex, too large, or when the risk is not standard. In such cases, an insurer usually decides to survey the risk being presented. Usually, a professional is appointed to view such a risk and a report is drawn up. The insurance policy is evidence that a contract is in force. Such a policy is subject to the normal laws of contracts. Today, policies are scheduled policies. That means they are pre-printed as opposed to the narrative policies used in the past, wherein the policy had to be written according to the particular circumstances. The structure of a typical policy contains 7 sections. Generally, there is the heading, the company name and logo and registered office, the preamble, which sets out the terms governing the validity of a contract, the signature of the company official, the operative clause, which details the cover being granted by the policy, the exceptions, certain conditions, and eventually the schedule. A cover note is a temporary policy. Sometimes it is required that a cover note is issued until the policy is prepared and delivered. This is to prove that an insurance policy is in force. In certain classes, a certificate is necessary. This is issued in conformity with the law. It is normal practice that an insurer sends out to the insured a renewal advice informing the insured that the policy is due to be renewed. If the insured pays out the premium, then the policy is renewed for another year. Some policies come with days of grace, which means that although the policy expires, the insurer will allow a further number of days during which the premium could still be paid without affecting the validity of the policy. The job of an underwriter is to assess the risk being presented by the proposer. In fact, the job of an underwriter is to analyze the risk and decides whether to accept it or not, or to accept it in parts. The underwriter determines the conditions, the terms upon which such a risk will be accepted, and of course calculate an equitable premium. An underwriter would of course be an underwriter is considering the risk upon the various hazards that such a risk brings about. In certain cases, an underwriter decides to share the risk with another insurer or reinsurer. The types of hazards being analyzed are either physical, that is, those that have to do with the physical characteristics of the risk, or moral, those that are related to the behavior and attitude of the proposer. The premium being charged will be based on certain factors, specifically on the claim costs expected, with an additional consideration for outstanding claims, together with a contingency reserve, and of course such premium must be enough to cover the costs expenses of the company as well as for the profit. However, the amount to charge as premium will also be dependent on external factors, like for example, inflation, interest rates, exchange rates, and competition within the market. We have mentioned reinsurance earlier on. This is the way an insurer shares the risks with another. In fact, in certain cases, especially when the risks are new, complex, or too large for an insurer to handle, such risks will be shared with a reinsurance company. In this way, an insurance company enjoys peace of mind. It will avoid fluctuations in its accounts. It will increase the capacity to underwrite certain risks. Also, an insurer will be safeguarded from catastrophic risks. Such an arrangement brings about a macro benefit, since the country being affected by a catastrophe will be supported by reinsurers who are usually appointed away from the domicile of the insurer. Coinsurance is also a sharing arrangement. However, in this case, the risk is taken upon by several insurers rather than a reinsurance company. Such a risk is usually brought forward through a broker. The broker usually approaches an insurance company, which in turn provides the terms and conditions of the policy as well as the premium to charge. Then other insurance companies will follow, completing a co-insurance arrangement.